Next on our agenda, I am very pleased to have the founder of Bridgewater Associates, Ray Dalio, joining us today. I would say a thought. When we created our most influential list, we avoided ranking them from 1 to 50. We thought, or I thought, that that would be false precision. I wanted to avoid that, and I also figured that's really why God created alphabetical order when you've got a list like that. We did have the task, though, of choosing in each of our 5 main categories somebody to profile. And in the money manager group, it seemed very obvious to me that the choice could be none other than Ray Dalio. He's had a 20-year record that is incredibly successful. Plus, there is always the Bridgewater Daily Observations, which I think many in the room may be familiar with. Ray will be interviewed today by the co-host of Bloomberg Television's Inside Track, somebody I've had the pleasure of working with for about a decade, I believe. So Erik Schatzker, take it away.
Thank you very much, Rob. Good morning, everyone. Nice to see you here. Ray, thank you for joining us. Folks, I have the suspicion that many of you in this room, if not most, perhaps all, know a little bit about Ray Dalio, and that's why you're here. First, you know that he's a hedge fund manager, but he is not unlike, or like, I should say, other hedge fund managers. Ray, you operate according, people have probably heard this before, you operate according to a set of principles, precepts you might call them, a series of templates, a framework, if you will, for understanding everything, from the economy to personal relationships. People here know, Ray, that you have, as Rob just alluded to, delivered some astonishingly big and consistent returns, some 15% a year for almost 20 years in your biggest fund, and on an extraordinary scale. Bridgewater Associates, his firm, manages more than $120 billion. And they know that you predict a long and painful recovery for much of the developed world, especially the peripheral EU. What they've come for, though, is a taste of the secret sauce. So first, I want to give you an opportunity, if you will, to briefly explain what a principle is, because it is going to be central to our conversation. And the principles are often confused for something else. So set us straight.
Okay, so I don't mean an esoteric sort of thing, and I don't mean like to be lecturing to people about what their principles should be. I just want to clarify that what I mean by principle means a description, first of all, an understanding of what reality is and how reality works. Reality works in a certain way. And so, for example, there's an economic machine. And so when we're talking about the financial crisis, or we're talking about deleveraging, there is a machine. The machine works in a certain way. Can we describe how the machine works? We should be able to describe how does the machine work, how does the deleveraging work? And then we also should be able to say, given that reality works that way, what is my principle for dealing with reality? A principle means how do you deal with reality to get the outcomes you want? So that can apply to any part of life. If you're learning how to ski and you say, put your weight on the downhill ski, it's just a reality that that'll help to make the turn better. So it's what are your descriptions and means of dealing with reality so you get what you want. That's all I mean.
Many of us here are interested in understanding most. I mean, and they can go and read about your principles for life, your principles for management, and perhaps even a bit about your principles for the economy, and I'll get to that at the end. They want to know a bit more about your principles for investing. Can you give us a few good examples?
Okay. An example would be that if I'll call it what I call the Holy Grail. Okay. If you get this, you'll get all the riches in the universe, or you'll make a lot of money. That is that if you have 15 or more good, uncorrelated return streams, that the math of that is such that if you go from 1 to 2 uncorrelated return streams, that you will go from, you'll reduce your risk by about 80% at about 15. And there's a certain math to it, there's a certain structure to it. If I was to show you a chart, I could describe mathematically. So that if for example, if I had return streams that were 60% correlated, and I had 1,000 of them, I would only reduce the risk by about 15%. So, and there's a certain, and after 5 or 6, it's limited. So that there's a certain notion about when approaching investing, what do I want? I need to have a structure, a certain structure. That can come in the form of alphas and betas. So at betas, what is my risk neutral position? So I'll say that everybody in the room, they say, what should I invest in? They don't start off, I think, with what is a neutral position? What represents a good neutral position? Balance. For example, does gold represent a part of my portfolio? What should, if I had no view, what should the concentration in dollars be? What is a structural beta portfolio? And then how do I take a deviation from that beta portfolio, which is the alpha, in order to add value? And how do I do that in an uncorrelated way so that I can then maximize my return to risk? So in that first principle, what I'm saying is that if you follow that first principle and you get 15 good, don't have to be great, uncorrelated return streams, you'll improve your return to your risk by a factor of 5. Okay, that means 5 times the return for the same amount of risk. That's just a principle, that's a reality. Everybody would agree on the math of it. And then that'll determine an action. So what am I going to do? Well, when I'm structuring my portfolio, that'll influence the way that I structure my portfolio to get what I want.
People say correlation among different asset classes is increasing, making the job of being a macro hedge fund manager harder. Is that true?
No. So I think that I'm worried that we can digress into the nature. I think that there is an intrinsic characteristic that determines the returns of asset classes. So a very simple example would be if you knew that if inflation was to come down by a certain amount, you multiply that times the duration of the bonds, and all things being equal, it'll carry over to the bond return. And so that there's a certain structure that exists in asset classes. There is no such thing as an intrinsic classic correlation. So the relationship between bonds and stocks, for example, could either be positively correlated or negatively correlated depending, and both of them make sense if you know what determines the pricing of that asset class. So bonds are always logical in that way. Stocks are always logical. But if you come into a time, for example, when economic uncertainty and volatility is greater, then they'll be negatively correlated. If you're in a period of time where inflation uncertainty and volatility is greater, they will be positively correlated. Both of those things are logical, okay, if you know how they behave. Therefore, it's that understanding, not a fixed notion that there should be a correlation. That fixed notion of a correlation doesn't exist. There's no such thing as correlation. There's only the logical behavior of each of those two markets that then will determine its relationship. And so when I say uncorrelated asset classes, what I'm really doing is not using the classic measure of correlation like it's stocks and bonds at 40% correlated. What I'm instead really referring to is, do you know how they behave? And is it going to intrinsically behave alike or differently?
Many other call them macro managers. That's unfair. Not many. Very few have had great runs of consistent big returns. George Soros, Bruce Kovner, just stepping down as of this week. Is what they do comparable to what you do, some of what you just described?
So I don't know enough about exactly what they do to comment on that. I could just better answer your question if it's directed more toward what I do.
Are you ever
I would
tempted
describe
to do...
some things that I do that I think might be different.
Mm-hmm.
I think that every transaction, every price of anything is a function of a transaction. There's a transaction that takes place. And that transaction is an exchange between buyers and sellers. And what happens is that a buyer gives money and a seller gives the thing being a stock or a widget. And that the price of that will be a function of the total amount of buyers spending divided by the quantity of things exchanged. And if I can go down and understand the behavior of those, then it's all logical and it makes sense for me. So for example, in the financial crisis, okay, there's nothing surprising about the European debt crisis. Should be no surprise because the payments were due. You know, in other words, we could take the payment streams, you know, the maturities are gonna happen here, and there's this quantity. This whole notion that there's a perception, like faith, does not make sense because it's not like that. Every day there's an exchange. And if you look at all the reasons for that exchange, there are some reasons that some are allowed to own this, or let's say banks buying. Banks, when they buy bonds, have limitations. So because they bought a certain amount of bonds over a period of time when they could expand their balance sheet, does not mean that they continue to do that because they can't expand their balance sheet. So therefore, you could not have that same amount of buying, match that number up to the amount of selling that needs to happen. Is there a gap? It was apparent, I think, should be apparent, if you do the numbers, that there would be a gap. How big is the gap? Who is going to fill the gap?
So what does that mean? Let's follow on to that point for a moment. If the financial crisis in Europe and what's taken place thus far, what's happening now, is not surprising, what else won't surprise you? In other words, what's almost a foregone conclusion in the sense of what has to be done to solve the problem?
I think that the most important thing that we should have is a quality conversation of how the machine works. In other words, not when you, like there are two levels I can answer that question at. You know, like what needs to be done? Well, the choices are you can either transfer wealth from the rich to the poor, or you can print a certain amount of money, or you can write down the debt. And you can go through and you can figure out which of those you want to do, and that's one level of choice. The biggest problem, I think, is not having a quality enough conversation at the higher level of how does a machine work? What are the choices? What has happened before? Like you know, the IMF, and you just have to go through a list of sovereign restructurings. There's a certain process. It works a certain way for good logical reasons. Do you understand how the machine works? And I think that the thing that has to be different is the stepping back, generally, understand how does a deleveraging work? How's the economic machine work? And therefore, what's going to happen? How does politics work? Politics, in the history of democracies, when we have economic crisis, there is greater polarity in democracies. And then it becomes less functional. This is very normal. Hitler came into power in 1933 because there was disorder in a democratic system, in a depression type environment. So all of those, that's how the machine works. And the machine basically, so let's have a quality conversation of how does the economic machine work, the political machine work, and then if you understand that, that's what I mean, reality, principles, then you can know how to deal with it.
Well, does understanding how the machine works lead to a better outcome?
Yes, that's the essence, right? In other words, everything
But is
in
the
life,
outcome is the outcome at all good? In other words, if you talk about transfer of wealth, reconstruction, monetization of debt, all of those have unpleasant consequences.
I'm not saying everybody gets what they want in life. I'm saying that the best choice, everyone's faced with choices. They have their circumstances. And then the question is, how well do you make your choices? So do you understand what reality is? Okay, no, you can't make the old party that everybody's going to borrow a lot of money and have a party, that those days are, you can't do that again. You can't continue, you run out. It's like, so a deleveraging in a very simple sense is, let's imagine you, take a moment if I can to explain it. Let's imagine that you have, you earn $100,000 a year and you don't have any debt. Then you can go to the bank and you can borrow $10,000 a year. You can spend $110,000 a year. When you're spending $110,000, somebody's earning $110,000. And that allows them to go to the bank and borrow. And you could continue to do that for a number of years. If you do that, your debt will rise relative to your income. Doesn't mean you could do this forever. Your debt will rise relative to your income, and then you will get to a point where your debt service cannot service that. You can alleviate that by lowering interest rates. Lowering interest rates has a certain effect. Then you get to something where you can't lower interest rates.
Where we are now.
And then what you're going to have to do is you print money and so on. This has consequences. So that when you reach the point that you can't do it anymore, and the way it always works is it's always the private sector first, always through the banks. So the banks leverage up. It's not a velocity of money thing. There's no such thing as velocity of money. You can make credit out of thin air. If you go into a department store and you buy something, a suit, you could sign your credit card, you can walk away, and you have created credit. Credit is a promise to deliver money. It'll produce GDP, but you'll create credit, And that's the way the machine works. So you reach a certain point that you can't do that anymore. Now, if you're asking me, can we go back and continue to do it? We can't go do that. But we can understand the reality of it, and we can then say, how do we deal with this in a logical way? There's no reason to be surprised at all of this. There are choices, and how do we best apportion the money? How much is going to be transferred? So, you know, there's a certain amount through the ESFS, and there's that number. If you just do the numbers, then how much of it is going to be essentially money creation, or let's say the expansion of the balance sheet, the private credit by the ECB, or how much of it is going to be restructuring? Let's get those numbers right. Let's look at it, make sure it's orderly. That is a better path, I think, than the path that we're on, which is like every day's a big surprise.
If a better outcome is possible, why are you so, call it pessimistic, about the prospects for peripheral Europe?
Well, so there's two basic paths here that influence my outlook. Like, will that be done well or will it be done poorly? That's the first thing. If it's done well, it means that peripheral Europe's party is over. And so they're going to have to go through a managed deleveraging, very much analogous to the Latin American of the 80s. In other words, you have a scenario that would be the lost decade in Latin America. 81, we have the crisis. 91, we have Brady B. bonds restructuring, and we go down a path that's like that. Okay, the party's over though. Or you can have something that is worse and badly managed. So that's why I'm pessimistic. You would say one of those things is going to happen. And then the question is it orderly? Is it well managed? And you know, because it's one of those.
Does the situation we face here in the United States in any way resemble the prospects for Europe, or is it, I hesitate to say, considerably better?
So I think it's better in that because we can print money. Okay, so let's break the world into two.
And that is a good thing right now.
Oh, it's a handy thing to have. It's a good, it really is. So let's break the world. There's two worlds. There are debtor-developed countries, which have reached...
Like this one.
Like this one. The debtor-developed countries who've reached their ends of their long-term debt cycle and have to manage this problem, and also remain uncompetitive in that they're still running deficits. So those deficits mean they add to the pile of debt. Then there's the others, the emerging creditor countries. Enter China. China walks onto the scene. Okay, so emerging creditor countries, which are in the opposite position. Those two worlds can each be broken into two types. Those that can print money, those who have independent currencies and monetary policies, and those that have linked currencies and monetary policies. Those that have linked, if you're a debtor and you have a linked, and you can't print, you are crashing. You have a deep problem. On the other end of that spectrum, if you are a China and you can't stop printing because you have a linked exchange rate, you have a bubble issue. You have a debt bubble issue going on. So both of those extremes have the opposite kind of problems because they have inappropriate currency. They can't make the adjustments. They can't have the right currency. They can't have the right interest rate. They can't have the right fiscal policy. The fiscal policy won't do it. Then there are those that can move their currency. So if we're looking at where might we be better off, our attention turns to the Fed, right? In other words, if the markets are going to rally and things are going to be good, it's going to be the Fed that's going to come in and save us, right?
Is it?
Okay, that's another topic.
Well, okay, I don't know that we can get into that one, but let's describe what you just laid out. China versus, call it Greece, with the US, the UK, Japan in the middle as the global imbalance. If something doesn't give, what happens?
Well, we know how the machine works. Okay, if we all agree on how the machine works, if you continue to maintain those imbalances, then what's going to happen is the creditors build bigger portfolios of those assets. Those are liabilities. They begin to know that those are bad liabilities. I don't want to have those things. So this has happened through all deleveragings. So the nature of capital shifts, the nature of what's held, it starts to change. Something like the Chinese, rather than on the margin, or other Middle Easterners or others, creditors, or even ourselves, on the margin, choose not to want to make those loans. That they say, I'd rather hold other kinds of assets, and portfolio mixes change, currency mixes change, and so on. As those things change, then they have an effect. So for example, if there's less buying of long-term treasuries, then that becomes normally the path. Then it is normal, this happens all the time, then the central bank will make purchases of long-term treasuries to make that difference. That doesn't mean necessarily inflation, because you're dealing with a deflationary environment. It's a monetization of debt. Okay, lo and behold, we're monetizing debts in various ways. That has a certain dynamic that then changes what those portfolios are, and then it causes, a market adjustments. Naturally, governments don't want those market adjustments. Naturally, they try to intervene. As they intervene, so we have to eventually work our way toward equilibrium, meaning that the price at which we're exchanging goods and services at is sensible, that we're going to be competitive, that you have to be productive, or whatever, you've got to earn it. You can't continue to maintain those imbalances, and prices will change.
We want to get in a question or two, but I want to ask you first, because I know that this is an answer everybody's looking for. Lots of macro managers make the case for an economic framework. Lots of them aren't doing so well. Bridgewater is doing well. What's working right now? What has worked for you this year?
Well, I guess the biggest thing, like I said, this 15 uncorrelated thing, I think that, again, I can answer this at two levels. I'm going to answer at the higher level, which I think is the more important level. I'm constantly know that I don't know. The main reason I write the daily observations is we want to communicate well with clients and so on, but the main reason is because I want to know where I'm wrong. And so lots of times if somebody points something out, it helps me, and I want to have a diversified bet of uncorrelated bets. So if I'm doing well, it's not because you're going to name the one or two things that I pick great, because you won't do well over a long period of time. But doing that because you're playing Russian roulette, the day is going to come that you're going to be wrong. If you do it in a way where you really do have quality diversification and a whole bunch of things where you've got an edge on, so you're playing the role of the casino rather than the gambler in the casino, that's how you're going to make money, I believe. And so, some years are better than others, but it's, when I say some years are better than others, this year and last year were better than I expect, okay? We've had good, bigger than normal numbers. We expect something like that 15% a year, not to lose money. I think we don't want to lose money, 15% a year, and then you get better and worse, but you have to have that. My good year is basically because a number of bets have come well, not because one thing has come well.
I know we could go on. Unfortunately, we can't. Ray, I'd like to thank you. Ray Dalio.
Thank you, Erik.
Of Bridgewater Associates, an unusually serene view of the world. Now, Rob, before we go, I do want to mention, I mentioned a couple of things at the outset that Ray has written down, codified, if you will, some principles for life, principles for management, as well as a template for the economy called a template for understanding
the economy.
What's going on. They're going to be available on the Bloomberg Link website. There are going to be some links, so please have a look. You can learn a little bit more about Ray Dalio's view. Thank you.
Thank you. Great.